Good morning, everyone. Welcome to our seminar. We're going to discuss in this seminar the introduction of corporate tax in the UAE, which of course is a very exciting and hot topic right now. Many people are asking questions in terms of the impact on their business, what the rules will look like. It's safe to say there's been a lot of change in terms of tax in the region and in particularly in the UAE here. So hopefully you'll have a very productive session today. Just to begin with the introduction of the team who'll be presenting. My name is Shiraz Khan. I'm the head of the tax practice Al Tamimi across the region. I'm actually a tax lawyer with over 20 years of tax experience, initially in the UK and the last 10 years here in the Middle East. I'll pass over to Janet to introduce herself.
Sure. Thank you, Shiraz. I'm Janet, and I'm a senior associate in the tax practice of Al Tamimi. I'm a UK and Malaysian qualified lawyer, and I have over 9 years of international tax and legal experience in the Middle East, Malaysia, and the UK.
And I'm Midya. Yes, thank you. I'm an advisor in the team. I'm also a tax lawyer with 8 years of experience with international taxation and also focusing on family businesses. I've worked mostly in Europe and in the UAE, and I'll pass it over to Yanis.
Thank you, Midya. I'm Yanis Nanos. I'm a transfer pricing advisor. I've been working in Western Europe, in London and Luxembourg, and the last 5 years I've been working in Dubai.
Thank you, Yanis. So in terms of our agenda for today, we're initially going to focus on some of the drivers behind why corporate tax is being introduced. Then we're going to look at some of the measures that were announced a few weeks ago by the Ministry of Finance. And then we're going to finally look at the impact of businesses in the UAE and what businesses should be doing right now in order to prepare and be compliant from 2023 or 2024, whenever it's applicable, before we conclude the presentation with a Q&A. Just to start off with a few housekeeping points. First of all, the session's being recorded, and we're aiming to share a recording of the session after it concludes. The audience is going to be muted. If you have any questions, please do submit them through the Q&A function. Of course, the Q&A session will be at the end of the presentation, so we'll aim to address as many questions as possible in the Q&A session. We will have polling questions throughout the presentation, so be ready and look out for these, and please try to participate so we can actually measure the actual engagement. Finally, if you can't hear us, please make sure you've connected your audio and you choose to either connect through your computer, audio, or phone. So we're starting off with a polling question straight away. Were you expecting the introduction of corporate income tax in the UAE? We just give you some time to respond. Could we have the results now, please? Okay, so if you could see the results, almost half of you were expecting corporate tax to be introduced. It looks like 11% of you were very surprised, hopefully pleasantly, I'm sure. So just it looks like many of you were expecting. I was actually expecting most of you to say that you weren't expecting it. So that's a very interesting outcome. Okay, so just to begin with, what were the drivers behind the introduction of corporate tax in the UAE from 2023? Before I go on to that, I'll touch on what corporate tax is. Many clients are asking the question that, VAT was already introduced. Are we going to be taxed twice? So therefore, at the beginning, I think it's important to make a distinction between what corporate tax is and what value-added tax is. There's a very big difference between the both. Value-added tax is known as a indirect tax. Corporate tax is known as a direct tax. And the reason why we refer to them as an indirect tax or direct tax is just when it comes to value-added tax, it's actually on the supply of goods and services. Ultimately, someone will bear the tax. However, it's not imposed directly on an individual. So it's an indirect tax because ultimately, as a business, it shouldn't be a cost for you. So as a business, most businesses will actually collect value-added tax on behalf of the government from their customer and remit the tax to the tax authority. On the other hand, corporate tax is a direct tax. It's directly imposed on the person, whether it's a company or an individual carrying on a business. And secondly, corporate tax obviously is a tax on the income of the actual person. And therefore, it actually is a cost to the person other than the ordinary cost of compliance. So this is the basic difference between corporate tax and value-added tax. Now, in terms of why corporate tax is being introduced, I think that there's a long story and background behind this. It goes all the way back to the recession in 2008, 2009. Many countries went into budget deficit during that time, and they were looking to generate additional revenue. So for most countries, their primary revenue generator is tax. So what happened at that time, a lot of focus went on multinationals who were perhaps set up and benefiting from tax treaties. The international tax rules were considered to be out of date at the time, and they didn't actually deal with the expansion and growth of these multinational organizations, which initially used to operate within one or two countries, but then grew quite rapidly to operate in multiple countries. And also there was a concern that there's many companies that were setting up and using treaties, international treaties at the time, which were designed to eliminate double taxation. However, these companies were trying to use these treaties to effectively not be taxed anywhere. So these were some of the concerns. So there's a whole project which was started off by the OECD, who were approached by the G20 to look at how to address some of these concerns and how to tackle this tax avoidance globally. So they started off a project called the BEPS project, Base Erosion and Profit Shifting Project. And under this BEPS project, they proposed 15 action points in terms of how this could be addressed. Now, as a follow-up, or you could say as an offshoot from this main BEPS project was BEPS Project 2. Which essentially had two pillars. The first pillar dealing with the allocation of taxing rights, and the second pillar dealing with a global minimum tax. Now, the main driver behind corporate tax being introduced actually is Pillar 2. And Pillar 2 seems to have gathered a lot of momentum very recently. There was a meeting of G7 countries. Then there was a meeting of G20 countries. And the OECD have rapidly sort of gone on to propose a global minimum tax of 15%. The idea is that if you're operating in a country where the tax rate is less than 15%, or otherwise, or there's no tax, or perhaps you have favorable tax treatment, then you'll be taxed in another country, if you don't have that minimum 15% effective tax rate. So this is one of the reasons why the UAE looked into it. Of course, value-added tax was only introduced in 2018, and prior to that, corporate tax was already under discussion. But the decision was made to proceed with value-added tax and perhaps look at the corporate tax in the future. But because of these developments on this proposal to have a global minimum tax, the UAE essentially faced a choice. Does it actually adopt this? And then in terms of how does it adopt it? Does it selectively apply this to those organizations who are affected by Pillar 2? Because Pillar 2 really applies to large multinationals who have certain global consolidated revenue, and obviously the figure is very, very high. Or do they have like a broad brush corporate tax across the UAE to which they apply corporate tax at the same rate? And then the third option was that they have a corporate tax with a higher rate, a standard rate, and perhaps a lower rate for smaller businesses, which was perhaps more fair. And that's the route they've actually gone down. Of course, that was one of the main drivers, and the IMF have been encouraging the UAE to look at the potential introduction of corporate tax to help in its vision and aim to diversify away from the oil and gas revenue. And of course, tax, is a main source of income to fund public services and expenses. But at the same time, the UAE obviously, has a global standing as a financial center, and it wants to be considered as a leading business hub and financial hub. Is a friendly business and stable tax environment. So that's why, the regime had to be really carefully thought about. Now, moving on to the next slide, I think just to give you a flavor of where we are before I look at the legislative framework. So, of course, we've had an announcement from the Ministry of Finance that corporate tax will be introduced in 2023 at the earliest. At this stage, there's no published legislation, whether law or regulations. So it's just an announcement, which effectively gives us an indication of some of the policy choices which were available and the policy decisions the UAE's made at the very top level. Of course, everything until the law is finalized can be subject to change. But the expectation is obviously things have already been thought about. For example, what kind of rates do we want? Who do we want to tax? Under what circumstances do we tax? What kind of exemptions, reliefs are we going to have? At least some of that thinking has already happened and some policy decisions have been made. And that announcement was no more than just a reflection of the actual policy decisions. So a lot of the detail hasn't been published yet, and I'm sure over the coming months, more and more things will be announced. So in terms of how the legislative framework will work, obviously, once corporate tax is introduced, there's expected to be either it'll either be one law or based on what we've seen for value-added tax and other taxes generally. There's a law which is supplemented by regulations. So the law sets out some basic detail and measures and rules, and then the regulations actually go into more detail in terms of the applications of these rules. Now, in terms of who will be administrating the tax system, obviously corporate tax will be the third federal level tax. So we already have excise tax, we have value added tax. Corporate tax will now be the third federal tax. And of course, we have a federal tax authority who's responsible for the administration, collection, and enforcement of all federal taxes. And corporate tax will be no different. So the federal tax authority will be responsible for administering the corporate tax system. There's also double tax treaties, and these are not the tax law. These are international agreements that the UAE has entered into with other countries, which have been modified because the UAE actually joined the multilateral instrument. So some of the treaties which they've entered have been modified by this. But there will be an interaction between these treaties and the corporate tax law, and you would expect some provisions in the corporate tax law dealing with this, because a double tax treaty is an international agreement which the UAE is committed to, and which it will respect, subject to all of these discussions which are going on and the multilateral instrument. So there will potentially be an override with some exceptions for treaties to prevail over the tax law. I mean, you'll see later on, based on some of the measures that we discussed, it's not going to have too much of a relevance because of the non-existence of withholding tax in the UAE. Now, in terms of the tax procedures, as most of you will be aware, there's already a tax procedures law and regulations in place, which deals with, amongst many other things, registration, the filing of tax returns, payments for corporate tax, voluntary disclosures, tax audits, tax assessments, tax disputes. So all the administrative aspects and all these procedures actually apply across all taxes. So corporate tax would be no different. So all these procedures set out, in the tax procedures law will be applicable to corporate tax, except where in the tax procedures law and regulations, there's no detail because it's tax specific. So in this case, the tax law, the corporate tax law, the regulations should set out some more detail. For example, the tax procedures law doesn't specify when you should register, when you should file a tax return. It just says that you should file a tax return on a periodic basis, and then the relevant law will determine when you actually file a tax return. So the final thing, of course, corporate tax is coming in for the very, very first time. And you could expect even before corporate tax is effective, the tax authority will issue some guidance. And over time, once it becomes effective, practice will develop. The tax authority will issue rulings. We call them clarifications here in the UAE. And over time, also once the litigation process starts, the courts start issuing judgments, and then the practice builds up. But this is very, very new in the UAE, and it's of course going to take some time as things develop. Now I'll hand you over to Janet, who's going to start off with the introduction on the scope and base of corporate tax here in the UAE.
Thank you, Shiraz. Now, in this section, I will walk you through some of the key aspects of the corporate income tax regime based on what we know so far. Now, as you have heard, the Federal Tax Authority and the Ministry of Finance have already issued, certain FAQs and guidance setting out, which gives us a good idea of how, the corporate tax legislation would look like. We will also share our observations, based on what we know so far. Now, in order to understand the impact and the application of the corporate tax regime, it is important for you to know, what is the scope and base of tax. So when is it effective? It will be effective for financial years starting from 1st June 2023 onwards. My colleague Media would later walk you through, how this would pan out in practice. Who would be subject to corporate tax? All individuals and legal persons carrying out business and commercial activities under trade or commercial license in the UAE would be subject to corporate tax. Now, they have indicated that there would be special rules that would apply for free zone companies, and we'll touch on this later on in this session. Now, under what circumstances would corporate tax apply? It is meant to cover all industry sectors except for businesses engaged in the extraction of natural resources. So currently, as all of you might know, in the UAE, the individual Emirates have issued their own income tax decrees at the Emirates level. But in practice, this tax is only enforced on oil and gas companies. And the income tax decrees at the Emirates level, they're not sufficient to tax companies. Now, at the Emirates level as well, there is also a separate tax decree that applies to branches of foreign banks. So what does the federal, corporate tax regime mean in practice? Branches of foreign banks are expected to be included under the scope, whereas businesses that are engaged in the extraction of natural resources will continue to be subject to tax under the current Emirate level tax decrees. As for exemptions, more details will be provided in due course, although there are certain exemptions that we'll touch on in this session as well that we already know. Now, in terms of the tax base, in order to determine what sort of income is subject to corporate tax, you need to understand how you arrive at taxable income. Now, we know that this is based on the accounting net profit of a business after making adjustments for certain items. And what these certain items are will be specified in the corporate tax legislation that will be published in due course. Now, although we don't have any details on these items that could be adjusted yet, we know as a fact that business expenses would form part of the deductions normally in corporate tax regimes. However, in order to claim these tax deductions, you might think it's a straightforward process, but not all expenses are automatically deductible. And because of this, this is normally a common source of controversy between tax authorities and taxpayers, especially in this region. Now, it is important also, once the corporate tax legislation is published, that you pay special attention to what are the conditions are to claiming these tax deductions, what are non-deductible expenses. For example, maybe fines and penalties may not be deductible. And you need to ensure that you put in, the proper controls in place so that you ensure that your tax deductions are correctly claimed. Now, what did it mean by accounting net profit? We know so far that it is the amount reported in the financial statements prepared in accordance with internationally accepted accounting standards. Next slide, please.
Just to add a couple of points here to what Janet is saying. Now, it's not clear at this stage, I mean, as Janet said, I mean, the intention is to tax individuals or legal persons who are actually doing business here in the UAE. And how are they going to determine whether they're going to do business is based on their commercial license or their license to effectively do business, especially when it comes to individuals. Now, what's not clear is that what will the taxation be? Will it be on local source income in the UAE, or will it be on a worldwide basis? Obviously, our expectation is that it should be on a worldwide basis for resident companies. And there's two major reasons for that, because they've introduced a relief for foreign tax, which is paid overseas, which typically happens when you have a residency-based taxation on worldwide income. And also because of Pillar 2, I think that the incentive is for them to tax resident companies on a worldwide basis, because otherwise it would defeat the purpose. So as I said, normally a lot of countries, some countries tax you based on this local source income only. Other countries tax you if you're resident in a particular country on a worldwide basis. And residency is usually determined by, in the case of a company, when you're incorporated in the country, or if you're not incorporated in the country, if you effectively have your head office here, or you're centrally managed and controlled here in the UAE. So this could have potential implications for, companies, even companies which are not incorporated here and incorporated elsewhere, but are being managed here because the directors are here and the strategic decisions are being taken here. I think the other thing was that, the indication seems to be from the announcement that you'd be considered as doing business if you're licensed to do business. The question mark is that if you're not licensed to do business, will you be considered as doing business or taxable? And my own view is that, if you have a license to do business, there's obviously a presumption that you're doing a business, but it probably definitively will not be tied into the license, because there are some circumstances where you may not have a license, but you may be considered doing business from a tax perspective. And generally, non-residents, they're taxable if they do business in the country through a permanent establishment. And for tax purposes, you may have a permanent establishment, but not be required to, for example, have a license. So yeah, I think a lot of this detail probably will be announced later on, but these are some of the issues which are being faced. Moving on to the next slide.
So as individuals, I'm sure you would also be interested to know how corporate income tax applies to individuals. Now, the key aspect to note here is, the question of whether do you carry on any sort of commercial, industrial, or professional activity in the UAE? And if you're a foreign individual, do you conduct activity in an ongoing or regular manner? Now, if you do that, then you'll be subject to corporate tax. It's also important to note, and I'll touch on this in the later slide, that as individuals, you'll still be subject to the taxable income threshold. So if you earn taxable income below that threshold, then you won't be subject to tax. Now, in the UAE, they've currently indicated that if you earn income from these activities and you earned it under a trade, professional, or freelance license, then you'll be subject to tax. Now, what is not subject to tax, and the key thing to note here, is whether that income has been earned in your personal capacity. So say, for example, investments in real estate. As long as you don't have a commercial license to carry out your real estate activities, or you're not required to have one, then any income that's earned from investments in real estate will not be subject to corporate tax. Now, the same goes for salary and employment income, and applies equally to both the public and private sectors. Dividends, capital gains, as well as other similar income that you earn from owning shares or other securities will not be subject to tax, as well as interest from bank deposits and saving schemes. Next slide, please.
Thanks, Janet. Just to add to this, again, there are some question marks. If you're an individual and you own some property in a personal capacity and it's investment property, it's clear, that there shouldn't be any tax. But what about if you're an individual and you have multiple properties and you're buying and selling these properties and possibly you're not even licensed to do it? So how will the taxation treatment be determined? Will you be considered as doing business and therefore taxable even if you don't have a license? Or will you need to have a license? So this is one of those unanswered questions.
Sure. So in terms of non-residents, as Shiraz has mentioned earlier as well, there is some indication that, of course, individuals and legal persons that are non-resident in the UAE would be subject to corporate tax if you conduct activity in an ongoing or regular manner. So maybe perhaps you're a business, a foreign business, and you don't necessarily need a trade license to conduct your activities in the UAE. However, from a tax perspective, it is quite likely that, as long as you conduct those activities in an ongoing or regular manner in the UAE and you derive income from it, you'll be subject to tax here. Now, in terms of dividends, capital gains, interest and royalties, and other investment returns, that is derived by non-residents, you won't be subject to tax. And separately, in terms of withholding tax, they have indicated that there's no withholding tax that would apply to domestic and cross-border payments.
Thanks, Jani. I mean, just to add to that, withholding tax is obviously a tax which a country usually imposes on the income received by a non-resident who doesn't have a permanent presence in the country. So usually it's passive type income, or it's investment income. And obviously UAE wants to maintain itself as an attractive jurisdiction in which to invest. So it's taken a decision for now not to impose withholding tax, at least initially. But this is something that potentially can be revisited in the future, because in a lot of countries you do get credit for the withholding tax you suffered, and it depends on who has the taxing rights as well. So it may not be the case that it's always detrimental to have a withholding tax. Just moving on to the next slide now. Just hand over to Midya.
Yeah, I'll touch on this. So in terms of the tax rates that are applicable, obviously to support small, medium enterprises, the government has now indicated that, if you earn taxable income up to 375,000 dirhams, you won't be subject to tax. And anything above that threshold will be subject to a standard rate of 9%. Now, it's also important to note that a different tax rate would apply to large multinationals subject to the Pillar 2 criteria of the OECD Base Erosion and Profit Shifting Project. Now, as Shiraz has mentioned earlier, in a nutshell, this Pillar 2 criteria was introduced by the OECD to address the challenges of the digitalization of economy. And so this policy is rolling out to ensure that countries around the world ensure that large multinationals are taxed at a minimum level of at least 15%. So what do you mean by multinationals? The definition that we have here is that it is a corporation that operates in its home country, as well as in other countries through a foreign subsidiary, branch, or other forms of presence. And large in this sense means that it will be a multinational corporation with consolidated global revenues in excess of 750 million euros.
Thanks, Janet. So, I mean, as Janet was saying, the the third rate is all we know is that there's going to be a different rate, which is going to be applicable to large multinationals. But currently, this rate has been set at 15%. So our expectation is that this rate is a minimum of 15%. Of course, it could be higher. So that's something to watch out for. But overall, I mean, if you look at the makeup, and as I was saying at the beginning, the UAE had option to either introduce a selective corporate tax applying to these large multinationals, to have a broad corporate tax across the UAE, and the same rate applying, which would obviously been tough for the smaller businesses, or having the kind of system that they have right now, which is a higher tax rate for those large multinationals, a standard tax rate for everyone else, and a 0% rate for the very, very small businesses. And this is very reasonable. It's very fair. And if you look at the standard rate of 9% in the UAE, it's actually the lowest rate in the actual region. Bahrain, of course, doesn't have a corporate tax, but Kuwait and Oman have 15%. Qatar has 10%, even in the free zone, the QFC. Saudi has 20%. So this 9% standard rate is actually the most competitive and lowest rate in the region. Moving on to the next slide, and now handing over to Midya.
Thank you, Shiraz. So now we're going to talk about the exemption, reliefs, and tax deductions that were mentioned in the announcement. So one of the exemptions is that if UAE businesses receiving dividends and capital gain from so-called qualifying shareholding, they should then not be subject to corporate income tax. What is considered as qualifying shareholding has still not been clarified. But Ministry of Finance did mention in their FAQ that a qualifying shareholding should be an ownership interest in either a UAE company or a foreign company that meets certain conditions, and that will be specified later on. Well, I think we can kind of compare this with the participation exemption rules that exist in a lot of different countries, including in Europe. And this rule normally has an ownership requirement. And if we look at the UK and Luxembourg, it's around 10%. Netherlands has 5%, but normally it's around 10% ownership requirement. It also has a retention period of around at least 12 months of the shares in the company, and the payment that is being given, so the dividends to the UAE company, should not have been deducted for corporate income tax purposes in the country of subsidiary. So this could be perhaps something that we might see in the rule that will be in the tax regime in the UAE. They might take some inspiration from the participation exemption rule. Another exemption that has been mentioned is the intra-group transaction and reorganization, which is referred to restructuring within a group. So let's say when shares of different companies are being transferred, or even assets, and it's intra-group, so it doesn't really affect, it's not really selling it, it's reorganizing within a group. Even here, we don't really have any clarification of what will be seen as a qualifying intra-group transaction or reorganization. But if we compare it to similar rules in different countries, it's normally a controlling requirement, so either through ownership or voting rights, and it's a minimum of 51%. Shiraz, would you like to add something there?
Sure. In terms of the participation exemption, as Midya said, they haven't told us what a qualifying shareholding is, but usually, you need 5 to 25% ownership based on some of the other jurisdictions. There's also a minimum holding period, which is typically 12 months to 24 months. And there's sometimes other requirements as well. So, for example, in some countries, you may have a certain amount which you should have invested. In other countries, there's a requirement for the company in which you invest in and which you own to be a trading company or holding company of a trading group. In terms of the intra-group transaction relief, obviously very little detail has been made available, but typically in other jurisdictions, and what we expect to see in the UAE is this to be effectively a relief for capital gains, where if you transfer assets within a group, so if you transfer assets or sell assets from one company to another company in the group, then the sale should take place at no gain, no loss. In other words, there shouldn't be any capital gain on the transfer. And this is obviously subject to certain requirements. It may be that you of course need to be part of a group. Now, what the definition of a group will be, it's not clear at this stage. It's usually 51%. It could be 75%. And also there may be a requirement for example, for a company to hold both the companies. There may be a requirement for all the companies to be held in the UAE. So this is some of the detail we'll see later on.
Definitely. And I think that having these exemptions in the coming corporate income tax regime, that puts UAE in a good position to, to be considered as a holding jurisdiction for group companies by being able to get exemption for dividends and capital gain and being able to reorganize the structure as well. So if we then think about or look at the taxable income with regards to the calculation, nothing like how it's supposed to be done has not been disclosed. But what has been disclosed is that the UAE businesses that does fall in within the scope of the corporate income tax regime, they will have to have financial statements prepared in accordance with internationally accepted accounting standards, with minimal exceptions and adjustments, and one of them is tax credit. So UAE businesses will be entitled to tax credit, a foreign corporate tax paid against their UAE corporate tax liability, which means that if a UAE company has paid taxes on the income generated here or related to the business here, and that income is supposed to be subject to tax in the UAE, then the tax paid in the foreign country should be able to be deducted against that tax. And this is kind of a very common feature in corporate tax regimes on a worldwide basis. So we've seen this is very common, and that's also where a lot of time the double tax treaties will be coming into role to see what are the requirements, what are allowed between two countries to be done when it comes to capital, when it comes to tax credit. And another possible deduction from the income tax is a deduction of losses. So the UAE corporate income tax will also allow a business to carry forward and use losses that have incurred from the effective date of the corporate income tax regime and offset it against income in the following financial periods. These losses will also be able to use through within tax groups, and this is something that I'll touch upon shortly after a couple of slides. But before we move on to talk about free zones, which I've seen already some questions popping up, and I know it's a hot topic, would you like to add something here, Shiraz, before we move on?
Yeah, just a couple of things. The tax credit which will be available is actually a double tax relief, and it's other than through the treaty. So you don't have to have a double tax treaty. And that's why this is called unilateral tax credit, because the UAE will give you this tax relief here. So in the circumstances where you have no treaty and the resident company here in the UAE is being taxed on the income in the UAE, and also possibly on the same income, another country is taxing on the basis of source, and it's subjecting the same income to tax. So in these circumstances, the UAE will give credit for the tax which is paid and suffered overseas. In terms of the losses, the carry forward losses, we know that there'll be companies will be permitted to carry forward losses. We don't know if there'll be a limitation on that. Usually, sometimes there can be a limitation in terms of the number of years you carry forward, whereas other countries allow indefinite carry forward. There's also a restriction as well. Sometimes if you have a change in ownership, and to go with that also, there's a change there's a major change in the nature and conduct of the trade or how the company does business. So for example, it changes ownership and it also changes its business activities. So in these circumstances, the carry forward of losses is usually denied. I think Janet, in terms of tax deduction, I think Janet touched on this already. So how things would work is that your starting point is the financial statements, which are required to be prepared in accordance with the international accounting standards. So you'd obviously prepare these financial statements. Now you'd start off with a net profit in the financial statements, and then you need to look at, from a tax perspective, whether all the deductions which were taken in the financial statements are permitted for tax purposes. Now, there's not too much detail available, but we expect a general rule which restricts the deductions for expenses for tax purposes. And this will normally be framed in the sense that the expense needs to be wholly and exclusively incurred for the purpose of the business. And more specifically, it needs to be necessary for the purpose of generating the income. So if it's, for example, if it's for the purpose of generating income which is not taxable or exempt, then no deduction should be available. And you have to obviously incur the expense, and you have to make sure supporting documentation is there in order for the expense to be deductible. There probably will be a limited list of items which will be disallowable for tax purposes. So I think Janet mentioned these fines. If you incur an expense for something unlawful, for example, that will also not be deductible. Sometimes shared expenses of head office is also not deductible. On the other hand, you might have some expenses which are not technically and strictly business expenses, but they may allow a tax deduction for them. So for example, charitable donations. So this is not a business expense, but the law may contain some provisions which allow a deduction for charitable expenses. Although there may be a cap on this, so it just all depends on what kind of policy and approach that is being followed. In terms of the exemption, obviously limited exemptions have been announced. Now there are also other potential exemptions as well. Of course, we expect to see an exemption for governments and even sovereign wealth funds. So we don't expect them to be taxable. And I think it's important to look at the Pillar 2 impact on governments as well. So the governments and sovereign wealth funds are also expected to be outside the scope of Pillar 2. Therefore, they shouldn't be subject on the face of it to the minimum tax rate of 15%. So that's why it'll be okay for them to have an exemption for governments. Another tricky area is, how does UAE go about taxing companies? Because in some of the other GCC countries, for example, Kuwait, Qatar, and Saudi, it's effectively the shares of nationals in the companies and also GCC nationals are exempt. So any profits in the company which are attributable to GCC shareholding are exempt. It's not clear whether this kind of approach will be adopted here. It's certainly not followed in Oman. So it's something that may or may not be adopted. I think what makes things more difficult is the Pillar 2 discussion in this regard. Because if you effectively give an exemption to a local company by reference to the shareholding of the UAE nationals and GCC nationals, then essentially if it's a large multinational, it may actually be affected by the BEPS 2 proposals, BEPS Pillar 2, and be subject to tax in another country. So this needs to be carefully thought about. I mean, it's possible that there may be a general exemption, but in cases where you're considered a large multinational, there may be a carve-out. Just moving on to the next slide, free zones, Media.
Thank you, Shiraz. I think we've come to one of the most important slides considering the discussions in the chat that I've seen. And I think it's a very important announcement because we have this concept in the UAE. We have free zones and we have mainland, and a different tax treatment will be applied on free zones during certain conditions. But I think what is very important to first of all state is free zones are subject to corporate income tax. They're not out of scope, they're in scope. But the thing is that the new UAE corporate income tax regime, they will honor, this is at least what the announcement has said, they will honor the corporate income tax incentives that has been offered to free zones, the so-called tax holidays, which are up to 50 years. But this is obviously under certain limitations. First of all, free zone companies have to comply with all the regulatory requirements that are that they have to follow. And secondly, they cannot conduct business with UAE mainland. What is conducting business with UAE mainland has not been clarified. But based on our expectations, any gain arising from business activities on mainland, including direct trading with customers on mainland by supplying goods or service, or any service that's not included in the actual trade license of the free zone company, should be subject to corporate income tax, most likely. So if there's a transaction between two free zone companies, or between a free zone company and outside of the UAE, so a foreign company, that should not be subject to corporate income tax based on the announcement. However, would there be any transaction between a mainland company and a free zone company, then there's a risk that corporate income tax would apply if the thresholds that Janet mentioned earlier are reached. So either the 9% or higher tax rate in case it's been seen as a larger group. So it is still very uncertain how companies, because how companies with mixed activities would be treated, because a free zone company might actually have a bit of a mixed activity. And the question is, will the net income that is related to the mainland transactions be subject to corporate tax, and the activities that are not related to mainland be out of scope or not, or be having a different kind of treatment? That is the question. And if that is the case, then the second question is, will the free zone company need to keep two separate P&Ls to keep track of the cost and profit related to the mainland transactions and what is supposed to be subject to corporate income tax? So a lot of question marks, and I do think that Shiraz, you have some input here that you would like to add.
Sure, thank you, Medya. Free zones are obviously a very important pillar of the UAE economy. And therefore, we were expecting, some sort of maintenance in terms of the tax incentives which are there. Of course, there's free zones at the federal level. So you have the DIFC and you have the ADGM, and you have other free zones which are there at the Emirates level. Now, in the absence of, any carve out, the federal law usually overrides the Emirates law. But we were expecting to see a carve out for free zones, and whatever treatment is applicable in these free zones, which is essential for some of these free zones to continue to be respected. And that's exactly what's happened. But it doesn't mean that if you just go and you set up in the free zone and everything is okay. So you have to look at exactly what you're doing. I think the message is that if you set up in the free zone and you respect the rules, you'll generally be okay. So as I said, there are some caveats in terms of when you'll be taxable. Essentially, you need to comply with the regulatory rules of the free zone, and secondly, you must not do business in the UAE mainland. Now, what does that mean? For example, I mean, if you're in the free zone and you're effectively selling goods into the mainland, is that compliant with your license? Is that doing business with the UAE? If you're providing services and because you have customers in the mainland, is that doing business in the UAE? What about if you're in the free zone and, for example, you have real estate and you're buying and selling property, or perhaps you're renting it out? Will this be considered doing business in the UAE? These are some very, very tricky questions. And then, as Medya said, if you have certain activities which possibly are outside of the mainland and they are not considered as doing business in the mainland, and then you have other activities which are effectively considered as doing business in the mainland. In this case, the expectation is, to the extent that your activities and income relates to activities in the free zone which are protected, then effectively this income will be ring fenced and not taxable. So only the income which you generate through not complying with the regulatory requirements or doing business in the mainland will actually be taxable. Essentially, this basically means that, obviously, if you're operating the free zone, you have a license. So there's certain specific requirements that you have to adhere to. To the extent that you step outside those requirements, you're not acting within the scope of your license, then effectively you're not complying with the regulatory requirements, and you'd be taxable in respect of that income, potentially. And then also, if you're doing business with the UAE mainland, and exactly what this means needs to be defined, as Medya said. But if you're coming and having meetings in the mainland, or you have customers, then this could be indicative of the fact that you're actually doing business in the mainland. Moving on to the next slide now. Tax grouping, Medya.
Thank you, Shiraz. Yeah, so we're now going to talk about tax grouping, and this is kind of similar to the existing UAE VAT regime that you can actually group UAE companies. So this this means that a group of UAE entities could be able to form a tax group, which would bring certain benefits, including a group relief and the possibility of using tax losses from one group company against another, which I kind of mentioned earlier today during this webinar. And it would also facilitate the filing obligations. So by just having a tax group, you would just need to submit a single corporate tax return on behalf of the tax group. What is the requirement exactly to be able to create a tax group is still not defined, and no hints or clarification has been given by the Ministry of Finance yet. But would it be similar to the VAT and a controlling kind of requirement such as 51%? Could be. Would it be higher? Will it be a certain period of time to hold the shares in the companies within the group? These are the questions that will would need to be clarified by the authorities. But another question that also might be raised and people might be wondering about is the possibility of creating a tax group with free zone companies and mainland companies, because I mean we have a lot of clients with mixed structures with both mainland and free zone, and the question is, would you be able to kind of have a tax group for that? Well, I do believe that will kind of depend on the tax treatment of the free zone company. So first of all, that needs to be clarified to know how a free zone company will be treated if they have mixed activities, or when are they going to be subject to corporate income tax. And if a free zone company would be subject to corporate income tax, then most likely it would be possible to create a tax group with mainland entities. But if it's not, then most likely, in my belief, it wouldn't actually make sense to create a tax group, even though, and we're going to talk about that in compliance, even though even a free zone company has obligations to submit tax return and to register and submit tax returns. But then the question is, would it even be possible to create a tax group with a free zone? And before we move on, I'll let Shiraz chip in here.
There's just a few things. I mean, obviously, we know that there'll be a concept of tax group. Now, there could be a tax group for consolidated filing purposes. There could be a tax group for reorganization purposes. And we looked at that relief, which is available. And there's also a tax group for group relief purposes, where effectively one company, which is loss making within the same group, can surrender its losses to another company within the same group. So the mechanics of that, are not clear at this stage. But also, what's not clear is whether it'll be the same definition. It's possible for all these three different purposes, we have a different definition. So maybe, for example, for consolidated filing, you only need to have 51% ownership, but you have a higher requirement of ownership, maybe 75%. If you're going to do group relief within the group, or you're going to have a reorganization relief. So that's something which remains to be seen. Moving on to the next slide.
Yes. So as I mentioned just a couple of minutes ago, UAE businesses will be required to register for corporate income tax purposes, and that is applicable to all UAE businesses, including free zone companies. Moving a bit too fast. When it comes to filing, there will also be a requirement of filing a corporate income tax return per financial period electronically. And just to clarify there, so that means because it is announced that the corporate income tax will be implemented 1st of June 2023. So companies with a financial period that starts on 1st of July 2023 and ends on 31st of June 2024 will have to file for that period and will be subject to corporate income tax from exactly the calendar period, for the financial period. While a company who has a financial period that is similar to a calendar period, which is 1st of Jan until 31st of December, they will be subject to corporate tax from 1st of Jan 2024. So it starts 6 months later because of the if the implementation of corporate income tax would be applicable from June 2023. When it comes to advanced filing and payments, no provisions yet, so that's not going to be a requirement, but similar to the VAT regime, penalty will be applied for non-compliance with the corporate income tax regime. And as I previously have mentioned, international standards on, well, acceptable international accounting standards will be required for accounting the net profit of the businesses. I'll hand it over to Shiraz to touch upon the economic substance.
Of course, economic substance requirements were announced, several years ago, and many companies have been following them. So a lot of clients are asking the question, what happens to economic substance now that corporate tax is coming in? My personal expectation is that economic substance rules will probably be phased out over time. One of the reasons why economic substance regulations were issued, because at that time, the UAE didn't have a federal level corporate tax. And therefore, other countries wanted to make sure that, in order, that effectively all the companies which are set up here and benefiting from the treaties effectively have a minimum level of economic substance here. And that's why these rules were introduced. But, I think most companies will be required to register with the tax authorities and file tax returns, even if no tax is payable. And for example, even in the free zones. So that's why probably over time, these rules would be phased out. In terms of the corporate tax filing, obviously what's clear is that there'll be a single filing, so it won't be like VAT. For corporate tax, there's usually a single filing, and after several months after the financial year end, you have to file a return. In the region, that's typically between 3 and 6 months. So you could expect the first filing, maybe 3 to 6 months after the end of your first financial year end, which is subject to the law. Now I'll hand over to Yanis to talk about some of the issues related to transfer pricing because of the introduction of the corporate income tax here in the UAE.
Thank you, Shiraz. With regards to transfer pricing, the frequently asked questions basically have introduced 2 questions. The first one is around the transfer pricing rules, and the second one is if the transfer pricing rules will apply in the case of the UAE businesses. So the transfer pricing rules govern the valuation of intra-group transactions for corporate tax purposes. A key concept within these rules is the arm's length principle. The arm's length principle is the international consensus on the valuation of intra-group transactions. And basically what does it say is that when you have transactions between related parties, this transaction should be priced the same way that it would have been priced if these parties were independent. On the second question is that the rules, transfer pricing rules, will apply in the case of the UAE businesses, and these rules will follow the OECD guidance. The OECD guidance is the one that most of the countries are following around the world. So in terms of the key areas of focus for the transfer pricing and for the UAE businesses, the first area is around the intergroup transactions and the pricing terms. So these transactions should be priced, I think, can you hear me guys well? Or okay, I will continue. I will take it. You can hear me. Sorry for it's not okay. Thank you. So in terms of the pricing of intergroup transactions, the main change and the main shift in the UAE is that these transactions should be priced based on the arm's length principle. We have seen a number of taxpayers that they have been following this principle because they have been doing that from a foreign corporate tax perspective before. But now the UAE tax authorities will also require that the pricing is done in accordance with the arm's length principle, also from a local tax perspective. The second area is around the transfer pricing documentation requirements. And having said that UAE will follow the OECD guidance, we expect UAE to adopt the 3-tiered documentation approach. That basically means UAE has already adopted the country-by-country reporting requirements. At the second stage, will also adopt the local file and also the master file requirements. It remains to be seen whether there will be any monetary thresholds with regards to documentation, or if it's going to be on if it's going to be any other requirements, additional requirements, as in the cases of KSA and Qatar. Last but not least is the transactions with regards to the type of transactions between domestic and cross-border intragroup transactions, and what will be the treatment of these transactions. We expect that these transactions would be expected to be priced on an arm's length basis, both of these types of transactions. And this is one reason is because these transactions, not only from a consistency perspective, but also from the perspective of making sure that any transactions between free zone and onshore entities that belong in the same group are priced accordingly, and there are no allocation of income to a more favorable tax treatment. That's from my side. Shiraz, if you want to add anything.
Yeah, I just wanted to touch on this. Obviously, many of you, may not even know, especially if you're just operating in the UAE and, you're focused on just the UAE. You've not had to think about this previously because the UAE had no federal level corporate tax. So transfer pricing was never an issue. I mean, what is transfer pricing? Transfer pricing effectively, as the word suggests, deals with the pricing on transactions between related parties. It's not relevant when it comes to transactions between parties that are not related. And effectively, the reason is because, once you have a related party relationship, you're connected, you can manipulate the value of the transaction and achieve tax benefits from it. So of course, if you inflate the expense and you reduce your revenue, then you're going to pay less tax. And when you have a related party relationship, you can manipulate the price to achieve these effects and therefore pay less tax. And that's why, countries have transfer pricing rules. Up until now, the UAE hasn't had to worry about it because there's no corporate tax. And countries usually introduce these rules to protect their tax base because they want to make sure that you're not reducing the tax in this country and effectively shifting the profits from this country to another country where there's no tax. So that's why now that the corporate tax will there's an expectation that there may be some basic transfer pricing rules within the law, the regulations, or perhaps there may be detailed rules and regulations issued in the future or guidance. But nevertheless, this is going to become very, very important because now you have to think about, the transactions between the related parties. Are you structuring the price? And the basic principle is that it has to be arm's length. Meaning that you have to set the value at a value effectively which you would agree between two unrelated parties. And not only that, you should also document it. So you need to document the relationship, the transaction. You need to characterize the transaction from a transfer pricing perspective. You need to look at comparables. What are other companies charging? And you obviously need to do this on an annual basis. And it's also more relevant when it comes to international and cross-border transactions. So that's the message here that, you haven't had to think about this previously, but now with the corporate tax law, it would be very important and relevant. So just the next poll question now. How ready is your organization for the implementation of corporate income tax in the UAE? Extremely ready, somewhat ready, or not ready at all? And just give you a moment. Hopefully, you could all make a choice now. So could we have the results, please? That's encouraging. So it looks like that, most of you, whilst you're not very ready, you somewhat do have an idea. And given that there's still some time for the corporate tax to be introduced, you could be in a position to get ready. When 29% voted that you're not ready at all, but there is still some time. Of course, corporate tax will not be introduced anytime soon. So the very earliest it will apply from the 1st of June 2023. To most companies, it will apply on the 1st of January 2024 because you have December year ends and your financial year start in January. So therefore, there is some time, and of course, more detail will be announced later on. The legislation will be published, and with all this additional information, you'll be in a better position to prepare. Moving on to the impact on businesses and what businesses should do to prepare. I think the first thing is that, as I mentioned at the very, very beginning, corporate tax is actually a cost, to businesses. So it does hit your bottom line. There will be a tax exposure. There will be a compliance burden. And right now we're dealing with the introduction of the corporate tax law for the very, very first time. So there's no precedent. It's not just an amendment. In some of the other countries where there's been an amendment or there's been a new law with a previous corporate tax system, we've seen that they've introduced it at very, very short notice, and organizations sometimes find it difficult to grapple with the changes and just to deal and understand how they're impacted. In the case of VAT, we saw that there was changes required to the whole business, different functions, the technology side, the legal side, the financial side, payables, and all of this needed to be looked at because it was actually a process where everyone gets involved, and it's going to have to be somewhat similar for corporate tax. So, you need to look at the impact of the introduction of corporate tax to your accounting, financial aspects, and also in terms of the business and customers. I think once the legislation comes through, it's going to be very, very new legislation. So it's to be expected that there will be some uncertainty. Obviously, there's been no previous corporate tax regime here in the UAE. So decisions will need to be made. And not everything will be black and white. There will be some uncertainties and you need to make some decisions. And in order to properly manage the risk, you need to probably take a view on, how to approach things, and also possibly whether you should go for ruling or clarification from the tax authority. Some of the key challenges we've seen in the implementation of VAT and also in jurisdictions where amended laws and regulations were issued or new laws and regulations were issued, although not for the first time. A lot of companies, they dealt with it very, very late. They waited for the announcement to happen. They waited for the laws to be published, and only then they started their preparation. What's recommended is that you don't take a reactive approach, but you actually take a proactive approach. And because they've made an announcement, certain policy decisions have been taken, and we know how a lot of things are going to look like. And so what you actually need to do is that you need to think about things now, in terms of what the likely impact is going to be. And later on, once additional guidance is made available and the law is published, then you could actually focus on what else needs to be done, and you can validate some of the findings. Training is also very, very relevant, and the key issue is the lack of training within businesses, a lack of awareness, and all of this collectively means that there's a disruption to you doing business. There's an additional tax cost, there's an additional compliance burden, and obviously penalty exposure as well. So it's important to get this right. One of the other things is that the role of a tax authority. Obviously the tax authority is there to guide you, to assist you, but their primary role is to administer the tax system, collect the tax, and enforce the taxes. They're not your tax advisors. So as we found with VAT, the federal tax authority is a new tax authority. They have very limited resources, and essentially their job is not to advise you. So they facilitate things, but they don't advise you. But a lot of people were expecting to be advised by them and calling the call center expecting answers, but that's not how things work. So you have to take advantage of all this time that you have and make use of it and deal with things up front proactively rather than wait for things to come to you. Now, another poll question, do you expect to deal with the introduction of UAE corporate income tax using in-house resources, or will you be seeking external assistance from advisor? So will it be in-house? Will you be going for like a mixed approach, or will you be outsourcing everything? Hi, Joe, could we have the results, please?
Hi, Joe. Can we get a poll question now?
It doesn't look like the poll question's gone out. I think a lot of people are asking. Okay, we'll revisit this. I think, okay. Some people are saying they can see the question, but they can't make the selection. Anyway, we'll skip this question for now. So I think once Joe, if you're ready, if you could address this issue, and then we could bring the question back on. I'll just move on to the slides. I think what businesses should be doing now in terms of preparing for corporate tax, of course. Okay, the polls questions come on now. Can everyone see it? Okay, great. If you could make a selection, and then we'll see the results. Hi, Joe. Could we have the results now, please? So it looks like that most organizations are going to take a mixed approach. So 77% of you will be having potentially someone in-house and also outsourcing it. Very few of you will be outsourcing it, completely. And some of you, very few of you will also be doing it in-house. And this isn't surprising. I think with corporate tax, it's considerably more complex than VAT. So whereas if you haven't made mistakes, the VAT tax return can be process driven, but corporate tax return generally has a lot more complexity. So it's very common to outsource this, and obviously have support, internally if you have someone responsible within the organization to work with the external tax consultant. So again, going back to what businesses should be doing now, I think you could break it down into 4 different aspects. So the first aspect is where we are right now. So we have an announcement, no law and regulations have been issued. So at this stage, I think that you shouldn't sit idle. You should probably get the thinking together. You should get people together internally within your organization, all the different stakeholders, and you need to raise awareness within your organization. So the key is to do an impact assessment now to see that, what you need to be done. So this may involve reviewing a legal structure. You may have a historical structure you put in place. And the critical part of that structure was that there wouldn't be any tax cost in the UAE. So obviously you need to go back and revisit this historical structure. And, potentially you may need to make changes because maybe it was very critical that there is no tax impact, and therefore you need to think about things. And the same goes with your legal structure. Maybe you could create efficiencies within your group structure. Maybe maybe you need to review your operating model and how you're doing business, how you're contracting. A lot of this, obviously things have changed a little bit with the introduction of VAT, but now I think with the introduction of corporate tax, this is going to be a major change to the tax environment and in terms of how you do business. And a lot of things were being done loosely in terms of agreements, in terms of invoices, and obviously with value added tax coming in and there being a requirement to issue tax invoice in certain cases. But now you need to think even more carefully about, your whole arrangement, how your legal structure is set up, what transactions you've undertaken, the agreements that you have, which entity is the best entity to enter into this agreement. and usually substance will need to follow form as well. So effectively you need to follow the substance and to think about who's actually the right person to be doing this transaction and other resources there. You also need to think about your resourcing needs and technology needs. For example, whether your current IT system could actually deal with the corporate tax reporting, or do you need to make some changes to facilitate that? Once the law is actually issued, then you could actually do a more of a detailed impact assessment. So the initial impact assessment will look at things at a very high level and obviously look at where things are not clear, so what the possible options are. And once the law is issued, then you can validate that because you'll have all the answers before you. Now, why do this initial impact assessment right now? Because some of the work that you need to do, the restructuring and the reorganization, that might take some time. And if the law is issued very, very late, which could happen potentially, it won't leave you much time with actually doing the restructuring. So it's better to start the work now, and at least in terms of a thinking perspective, so you could keep your management informed that, okay, these are the expectations. And now that the law's been issued, that this is what's been validated, so this is what we need to do. Again, it's all about raising awareness internally, documenting any uncertain tax positions that you have, encouraging training and education within the organization. And then finally, once the law is issued and before the law is effective, you need to do all the restructuring and look at your agreements, whether they need to change. If you have some uncertain tax positions, take some advice, obtain a clarification from the tax authority. You need to think about your transfer pricing as well and your tax policy and risk management framework, because from your organization's perspective, perhaps you need to assess, how to manage the tax risk. So who's going to take decisions at what levels? What's your tax policy? Are you 100% focused on compliance? Do you have a more aggressive tax policy, for example? And then after the implementation and once the law is enforced, and you need to think about registering, filing tax returns, making certain elections, for example, having a tax group, complying with requirements, for example, transfer pricing documentation, and then going forward, dealing with your disputes and litigation. So this is just in terms of how we can assist you. Of course, we'll share these slides with you so you could take a look at that in your own time. I think now we can move on to the questions and answers. So we obviously have just over 10 minutes. So we'll try to go through as many of these as possible. So there's a question here saying that just wanted to check, is a law out right now? As we mentioned in the beginning of the presentation, the law has not yet been issued. So certain policy decisions have been announced. And in terms of when the law is expected to be issued, we don't know when that will be. Certainly, there should be some more detail available in the middle of the year, which is what the Ministry of Finance promised. But the law may take some time because it needs to be fully drafted and approved, and therefore, it can take some time. There's a question here, will the Dubai government change the free zone laws, which have guaranteed 50 years tax-free? Midya, did you want to address that question?
Thank you. Well, I mean, for now, what they've said is they're gonna honor the already agreed on tax holidays. But if there's gonna ask the free zones to change the regulations and not offer any more tax holidays, that is a question to be answered. As of now, my belief is that there's not going to be any changes to the free zone laws, and as long as they are within the requirement, that is to say that they're fulfilling all the requirements and obligations and not having any transactions or business with UAE mainland, they should not be subject to corporate income tax, and I think that's something that would be still be there.
Thanks, Midya. I agree. I mean, there's no changes expected to happen to the free zone laws. Obviously, when the tax law is issued, it's going to set out the requirements. In terms of under what circumstances will companies establishing free zones be exempt, and under what circumstances they'll be taxable. So that's what we're waiting on. Moving on to the next question, there's a question here: are companies owned 100% by UAE nationals subject to corporate income tax? I dealt with this earlier in the presentation. You obviously have Saudi, you have Qatar, and you have Kuwait. These countries, they exempt the profit share of the nationals and also GCC nationals. However, I also touched on the fact that if the UAE follows this approach, and also those other countries, they continue this approach, they could potentially be taxed in other countries because these companies are having favorable treatment. So to the extent that they are multinational corporation, which has global consolidated revenue of 750 million euros, they could be taxable in other countries. So there's two options really: either to have this exemption, but to have a carve out, for example, where the company is actually a multinational corporation and has global consolidated revenue of more than 750 million euros. Or alternatively, you effectively tax all the companies. And Oman does this right now. So there's no exemptions for nationals and shareholdings by reference to nationals. There's a question here. This is the same question. Will corporate tax apply to businesses owned by Emirati nationals? And again, this hasn't been announced yet, but there could be a potential announcement. And it may just be limited to, my expectation would be if there is such an exemption, it'd be limited to those companies which are owned by Emirati nationals, but they're not multinational companies. There's a question here: if the year end starts on 1 July 2023, that will be the first year effective. Yeah, so the corporate tax applies from the 1st of June 2023, any financial years which start on that. So if your financial year starts on 1 July 2023, the first financial year for corporate tax purposes where it'll be applicable to will be 1 July 2023 to 30 June 2024. There's a question here: if the company's financial year starts in April 2023, does this affect the applicability of federal tax to them? Yes, it does, but not for this period. So as I mentioned, the first financial year where corporate tax has an impact are years that begin on the 1st of June 2023. So if your first year begins on April 2023, then for that particular year, it will not be applicable. So the first year it'll be applicable is April 2024. Will CIT law apply to UAE federal authorities generating revenue? I'm assuming that you mean government. My expectation is that it won't be applicable to governments, especially those governments that are acting in a sovereign capacity. So sovereign wealth funds and other government entities which are charging fees, it should not be applicable to them. But there's no such exemption being announced so far. So this is purely based on my expectations. How this effective date of 1 June 2023 will impact those that follow calendar year in terms of reporting, filing of tax returns for the year 2023. Media, could you deal with this question, please?
Sorry, I was reading the other question that was coming up in the QA. It's the question of how the effective date. Which question are we looking at? Sorry if I may ask.
I believe that the question is how does this effective date of 1st June 2023 will impact those who follow the calendar year in terms of reporting, filing of tax returns?
Thank you, Janet. There was so many questions popping up in the Q&A that I got distracted. So with regards to the reporting, so let's say if the reporting will happen after the financial year has finished. So if you are a company with July the 1st, 2023, then you will be having a financial year until June 2024 30th. So after that, you will be reporting on that year. How much time that's going to take, if that's within 30, let's say 30 days or longer, that's something that needs to be clarified exactly how the filing and reporting will be done. But basically, the filing will happen after the financial year has been finished. So there's no advanced payments or advanced filing to be taking into consideration. I do think we lost Shiraz. Oh, he's back. Perfect.
All
All
right,
right.
I'll just deal with the next question as well. So the next question is whether influencers or income earned through social media platforms will be subject to tax on their income if they're domiciled in the UAE. But I guess, so basically, if you're an individual, it goes back to the question of, whether you actually earn this because you do it as a living, and you actually, earn a living through carrying out all your activities through social media. And the answer would then be yes. Yes, if you carry it out on an ongoing and regular manner. And also you bear in mind that there is the taxable income threshold. So any sort of taxable income that falls below the 375,000 dirhams threshold would not be subject to tax, and anything above, if you earn anything above that threshold, then you will be subject to the tax of 9%. So we have another question here. Dividends, any specific rules around those as to what are qualifying and non-qualifying? Media, would you like to take this?
Sure, Janet, thank you. Yes, so as we kind of touched upon, it's still not clarified, but the Ministry of Finance did mention it very briefly in their FAQ that it is an interest. So it's an ownership, and it could be either a UAE company or a foreign company, but it's some sort of percentage of ownership at least. This is what they have announced. And if we look at similar rules in other jurisdictions, as we mentioned, the participation exemption rule, then there might be other requirements besides the ownership, which is between 10 to 25% normally, or 20%, I think Shiraz mentioned. It's the retention period of the shares, so you must have held them for a certain time, and this payment should not have been deducted from a corporate tax perspective in that country where the subsidiary is located. But this is still speculation, so we don't know exactly what qualifying would be, but definitely a sort of an ownership interest is going to be required, so some sort of percentage.
Thank you, Media. So the next question is multinational and large conditions have to be applied together, or existence of even one condition might attract tax at 15%? Yeah, I believe this question is addressed to the different tax rate that applies for large multinationals that fall under the Pillar 2 criteria. Now, what we know so far from the OECD is that the two conditions of being large multinationals need to be fulfilled so that the global minimum tax rate of 15% applies. Now, how this would be implemented in domestic UAE tax legislation is unclear yet, but what we do know so far is that what we expect to see is that taxpayers that fall under the Pillar 2 criteria, that being you need to be a large multinational, so you need to be, you need to operate in at least 2 countries and have a consolidated global revenue of at least 750 million euros. How we expect this to apply is that there will be probably required to calculate the effective tax rate for each jurisdiction. And then you have to pay a sort of top-up tax for that difference between your effective tax rate and that 15% minimum tax rate. And it is likely that any top-up tax would then be charged in the jurisdiction of your parent company of that multinational organization.
So thanks, Jani. I mean, I think we're running out of time now. I think we'll just take one more question. So this question has been asked quite a few times, actually, in terms of the tax position or for non-for-profit organizations and maybe foundations. Obviously, nothing has been addressed in the initial announcement in terms of how this will be taxed. However, our expectation is that such income should either not be taxable or exempt, in line with some of the other tax systems. We have had a lot of questions, and we'll get back to all of you. It may take some time. Of course, we haven't been able to do it right now because we only allowed limited time, but we'll get back to you, each and every one of you. Thank you for joining us today, and we hope you found the session productive and useful. And please do leave some feedback for us and through marketing. And feel free, if you have any other questions, to email us, and we'll try to get responses to you as soon as possible. Thank you, everyone.
Thank you all.
Thank you.
Thank you.